presenter is Victoria Tolstova. She will tell you about the stock's valuation in terms of information data.
Good afternoon, ladies and gentlemen. Do you feel comfortable? Shall I begin? Well, as Yana Vladimirovna said, my name is Victoria Tolstova and the subject is stock valuation in terms of information lack. The purpose of the paper is to investigate different stock valuation models in order to find which one is the easiest in application by individual investors in terms of information lack. So well, the question is bound to arise. Why should we point out on individual investors? Well, firstly, it's quite an unexplored category because almost all the researchers focus only on business. Secondly, the interests of individual investors are often neglected because it is thought that their free funds are just insignificant. But in fact, their funds are insignificant only separately, but in amount, this is quite a big sum of money. Please, draw attention to the graph. It shows the volume of money that is put in shares in Ukraine. You can easily see the positive tendency because over the 7 years, the volume of shares held by individual investors has increased almost 5 times. And we can conclude that individual investors in Ukraine are really interested in investing their funds in shares in order to save their money in the existing economic conditions where the level of inflation is one of the highest in the world. Well, the classical approach to evaluating share means using stock valuation models. There are 3 basic models, as particular the discounted dividend model, the discounted earnings model, and the discounted cash flow model. The Gordon's model appeared to be the easiest one because the calculation are just simple when all the models are different in the initial data. The Gordon's model enables investors to calculate the economic value of the stock. Then it should be compared with its market price. If economic value is greater than market price, then stock is undervalued by the market and it should be bought or held. On the other hand, if the economic value is less than market price, then stock is overvalued by the market and it should be sold. It's very simple. To use the model with actual data, let us estimate the value of the share of OJSC, Mobile Telesystems, or MTS Group. That is a very dynamic and promising company. It's the largest mobile operator in Eastern Europe that serves about 82 billion of telephone subscribers. And what's very important for individual investors, about 47% of their shares are free traded and available for everyone in the country. Exploring the financial data, the financial statements of the company, we could form the next variables as the estimated dividends for the next year, the predicted growth rate, and the required rate of return. Filling in the formula of the model with this data, we get the next results. Well, the economic value of MTS stock is $5.875 per share, whereas its market price is about $8.4 per share. So that the economic value is less than market price and the stock is slightly overvalued by the market. We can see that these results allow individual investors to avoid a serious mistake because as a whole the picture is quite promising. While buying such shares is not in favor of investor. And now perhaps it's the time to make the main conclusion of the work. So, the guidance model appeared to be the easiest in application because it needs little initial data, and on the other hand it provides clear results. Of course, the model has some shortcomings, as particular. Calculations are extremely sensitive to any changes in the variables, and besides, the model is based on some rather severe assumptions that has little in common with the typical company. But anyway, the guidance model shows approximate picture of the reality and allows individual investors to make right investment decisions in the majority of cases. Thank you for your attention, and now I'm open for questions.
Thank you for the presentation. So actually, Anna is the expert of company valuation at my chair, and therefore maybe she's allowed to ask the first question.
Okay, thank you very much. My first question, so you have presented only the discount dividend model, so you have worked only with this model, not with another one, so that you have presented on your first slide.
Yes.
Okay, only one model. My first question is, you have K as a required rate of return. What do you understand as a required rate of return? What could it be?
In our example, required rate of return is equal to expected rate of return. That is sum of money that individuals expected to earn from this investment.
Okay, how can you estimate this value? How can you estimate that you are expecting to get such a value?
It's a predicted number, and in terms of information lab, it's quite difficult to find out this data, so that after some analysis, I decided to use the interest rate of the National Bank as an alternative, because the required rate of return shouldn't be less than this rate.